Chapter 6, Accounting Assumptions, Principles, and Conventions. In this chapter, you are going to learn the importance of accounting assumptions and principles, and you are going to learn 5 accounting concepts which will be examined in paper 1. There are 3 main accounting concepts, going concern concept, consistency concept, and accrual concept. In order to help students to memorize all those 5 accounting concepts, I use the abbreviations CCBAC. CCBAC. The first C stands for a cost concept. The second C stands for a consistency concept. B stands for business entity concept. A stands for accrual concept. G stands for going concern concept. Before we start to learn those 5 accounting concepts, we should first know the importance of accounting assumptions and principles. First of all, we should know what accounting concepts are. Those concepts are the basic assumptions, notions, or principles related to financial reporting. Well, convention is the way of thinking and behaving that is widely accepted or believed to be proper. And about assumptions and principles, they are generally accepted by accounting professionals and are adopted by different businesses. They improve the objectivity and uniformity of financial statements. Such statements you are going to learn or you have learned are income statement and statement of financial position. Remember, objectivity and uniformity are very important in preparing the financial statements. Otherwise, if the financial statements are prepared in a subjective way and which is not uniform from day to day, from year to year, the users of the financial statements will see many difficulties in using those financial statements. Although we have mentioned about CCBAC, we start the business entity concept first. The definition of business entity concept, which states that the activities of the business should be kept separate and distinct from the activities of its owners and all other business entities. You look at the picture, you see the business and the owner are different and separate from each other, which means although the business is formed by the owner, the accounts of the owner and the accounts of the businesses are separate and should be in different preparation. As well, go on the second point. Transactions that affect the business should be recorded in the business's accounting books. That means if the transactions are not related to the business, they should not be recorded in the accounting books of the business. What the implication is that an owner's private items, such as a private car, say for example, you started a business of your own and you have your private car and private debts, personal debts, such property and debts should not be entered in the accounting book because the business and the owner are separate and distinct. So even though the owner has formed the business, the private car and the personal debts of the owner should not be entered or recorded in the accounting books. Similarly, an owner's personal expenses should be excluded from the accounting records of the business. That means, say, for example, you formed a business and you spent money with your family members. Such bills or expenses should not be included in the business own accounting records. This implies that the following personal activities of the owner should be entered into the business accounting records. Number one, that means if you have formed the business with a capital at the very beginning was $100,000, and now you're going to inject some more capital into the business. Such capital injection should be recorded in the accounting books, recorded in the capital account. As well, on the opposite, drawings of the assets such as cash or stock, that means you own the business and you took cash from the drawer of the business or the cashier of the business, or you took some goods from the business for your own use, for your family use. Such cash or stock withdrawals called drawings of the business. So a drawing account should be prepared to record the owner's withdrawal of cash and stock from the business. Let us look at the question. Mr. King owns a sole proprietorship and sells ladies' accessories. Which of the following transactions should be recorded in the books of his business? Here are 4 cases. Look carefully for the letters in red. Mr. King paid electricity charges of his private residential apartment using his own money. Now, should these expenses be recorded in the business accounting books? The answer is not recorded because Mr. King has spent some money for his private residential apartment using his own money. That means Mr. King has not used the money from the business. So this is not related to the transaction of the business. Because Mr. King, according to the business entity concept, Mr. King and his business are separate and distinct from each other. So Mr. King used his private money to pay for his private residential apartments. Electricity charges should not be recorded. But for those cases below, B, C, and D, all those cases are recorded in the books of the business. Look at it. B, Mr. King paid the electricity charges of his private residential apartment using the money from the business bank account. So obviously it should be recorded in the business accounting books because money was withdrawn from the business to pay Mr. King's private residential apartment. So the business should open a drawing account to record Mr. King's taking of his money, bank money, to pay for his private residential apartments electricity charges. C, Mr. King paid electricity charges of the shop using his own money. Okay, because the electricity charges of the shop is a kind of transaction, but such electricity charges are not paid by the bank account of the business or by the cash account of the business, but it was paid by Mr. King's own money. Because according to the business entity concept, Mr. King and the business are separate and distinct entities. Mr. King using his own money to pay for the electricity charges of the shop to record it as a new capital injection into the business. So when preparing the journal entries, we should credit Mr. King. We should credit capital account. Credit capital account and debit electricity charges. Debit electricity charges of the business. For D, Mr. King paid the electricity charges of the shop using money from the business bank account. Both of the expenses, electricity charges and bank account, are related to the business. So such transactions to be recorded in the business account. Let us look at the past paper. Peter sold his private residential apartment and gained $300,000. He intends to record this gain in his business income statement. State which accounting principle is violated and give an explanation. CEC-BAD. CEC-BAD, which one of it is it violated? Remember, the keywords is private residential apartment gain. Okay, this kind of gain should not be recorded in. Should not be recorded in the business income statement because Peter and his business are separate and distinct entities. So the gain should be recorded in Peter's own personal account instead of the business, though Peter established this business, okay, in the business income statement, okay, they are separate entities. So business entity concept is violated. We should state the definition of business entity concept, which states that selling private residential apartment is not a business entity. Not a business entity. That means this transaction, this gain, was about Peter's gain instead of the business gain, because the private residential apartment does not belong to the business, but only belongs to Peter. Okay, the answer is hence he is not allowed to record the gain as an income of the business. This shows that they are separate entities. Okay, after looking at the business entity concept, we go to the historical cost concept. Historical cost concept. In simplicity, we call it cost concept. Okay, the definition of the cost concept is that a business should record its assets at the original cost of acquisition. Acquisition means purchase. We acquire the assets. That means we purchase an asset. Okay, so the keyword is original cost. Another word is called market value. Okay, market value. Any subsequent changes in the market value of the assets after the acquisition are irrelevant. That means we do not concern on the market value of the assets. Why do we use the cost to represent the value of the assets instead of the market value? The importance was the highlighted keywords is objectivity and reliability. Because once you are given the accounting records, if the records are not objective enough or not reliable enough, we will not treat it properly. Okay, we will not believe the figures of the records. So historical cost concept, you can improve the objectivity and reliability of the accounting concepts. As well, the use of historical cost can eliminate then take away, okay, the chances of financial statements manipulation. That means just like look at the picture, manipulation means just like a puppet, okay. If some methods can be used subjectively or as they like, they can manipulate the accounts. That means they can enter any figures that they like to make it proper and to make it profitable. Okay, which will mislead the user's decision making. But there are some cons, that means disadvantages of using the cost concept, which is historical records do not necessarily reflect the up-to-date information of the business, because the access may be acquired many years ago at cost. Say, for example, the private apartment in Tranquillo, if you have bought the apartment many years ago, the cost or the value of the apartment was much lower than the market value nowadays, right? So if we make use of the figures, that means the cost, to make decision, which will lead you to make an appropriate decision, because it is not the market value, which will related to your decision making. So next point, historical records may be irrelevant to the current decision making. That means whether you will sell the apartment or not is affected by the current market price instead of the cost. Okay, look at the examination drill. Look at the question. ABC company acquired an office property for its own use at $2 million in a year of 2016. Due to appreciation of the property market, appreciation means the market price has increased. The office property is now worth $4 million, double the original amount. The owner of ABC company wants to increase the value of the property in the accounting records, reflect the current value. That means you as owner would like to show $4 million to reflect the current value instead of the cost that is $2 million in your financial records. But that practice is not good enough. It will violate the accounting principle. please state which accounting principle is violated and give an explanation. Because the question is talking about cost and market value, so the historical cost concept is violated, and then you proceed to give the meaning of historical concept by telling us that the office property should be valued at the acquisition cost, that is $2 million, in accounting records, so that the value of the assets will not be overstated. After looking at the business entity concept and historical cost concept, we proceed to the next going concern concept. The definition of going concern concept which assumes that the business will continue its operation in the foreseeable future. The keyword is foreseeable future. Okay, that means at present, the business has neither the intention nor the need to liquidate or cut back its scale of production. That means if you have many branches in Hong Kong, if you have the intention to close all the branches, or you have the intention to cut a lot of branches around Hong Kong, that means the going concern concept cannot be in use. The implication is if this business continues to operate in the foreseeable future, the financial statements should be prepared on a going concern basis. That means the assets should be recorded at the historical cost in the accounting records. Just you look at the hand-in-hand picture. Going concern concept goes in hand with the cost concept. Because once we adopt the going concern concept, that means assume the business will go on to do business, to operate in the foreseeable future, the assets should be valued at the historical cost in the records. That means in the statement of financial position, instead of making use of its market value now. But if the business is going to close in the foreseeable future, the financial statement should not be prepared on a going concern basis. That means all the assets should be reported at the expected resale value. Such works shaded in green color can be exchanged with the words market value or market price. Okay. Let us look at the question to confirm if you know the concept of going concern concept. If the owner has decided to close down the business after the accounting year has ended, the keyword is after the accounting year has ended, the financial statements can still be prepared using a going concern basis. The key point is after the accounting year has ended. Is it about the foreseeable future? Foreseeable future? Please comment statement with a reason. In this case, the business will close down in the foreseeable future. Foreseeable future here means within a year after the accounting year has ended. 1 year is related to foreseeable future. So if the business actually closed down within 1 year, you cannot use the going concern basis for the preparation of the financial statements. However, if the business closed down beyond the foreseeable future, beyond means more than 1 accounting year, or maybe 2 years later, it is not what we call foreseeable future. So we'll go on to use the going concern concept to prepare the financial statements. That means we use cost to represent the value of the non-current assets instead of the market value. Next one is called consistency concept. Consistency means using from one period to the next period. Okay, look at the definition. Consistency concept states that the accounting policies and methods once adopted to be applied from one accounting year, accounting period to the next accounting period. That means we should not change what we have chosen the accounting policies or methods. Right here, we should use the consistency when preparing or when using the accounting policies or methods for similar items or similar transactions. What similar means the business may change its accounting method if it will result in a more appropriate presentation of the business financial results. That means if you have adopted an accounting method which is not appropriate because we have been using the accounting concepts or accounting methods or policies which cannot reveal a true and fair view of the business. We should change this accounting method. Okay, if you can show a more appropriate presentation of the result. But remember, in order to show a better financial performance, it's not a justifiable reason. It's not a justifiable reason to change the accounting policy because once we adopt the policy, but intrinsically, this policy is proper and appropriate for the calculation of, say, for example, depreciation. Okay, next year you're going to learn depreciation. Okay, depreciation of a non-current assets. Such depreciation methods should not change in order to show a better financial performance of the business. We have talked about the similar items or similar transactions. So classification is very important. Okay, classification of items should be consistently applied. We should not change the classification methods. For example, the classification of different classes of non-current assets should not be changed arbitrarily. Arbitrarily means on your own will, just like those assets. We should categorize these assets into equipment account. Okay, equipment account instead of furniture account. Why do we need to adopt the consistency concept? Because it would be more difficult for a business to manipulate its financial statements. Manipulate means taking charge and change the result of what was not expected by the objective means. The users of financial statements are able to compare the financial statements of a business in different periods because if we consistently use the chosen accounting methods or policies, the user of the financial statements can use them to compare the business performance in different periods from time to time. Otherwise, say for example, the report card, okay, of YY3, if we always change the grading method, ABCD, okay, of conduct grade of a student, the user, that means your employer or the manager of the tertiary institutions cannot compare whether your conduct has been improving or remain steady. Because the criteria, okay, the criteria has been changing for your conduct grading. Okay, what are the benefits of the consistent application of accounting policies from one accounting period to the next? What I've shown you before, the users of financial statement are able to compare the financial statements of a business in different accounting periods. That means from one accounting period to the next accounting period. Not finished yet. Business trends and performance can be identified and measured. That means we can show the trends of the performance of the business. It improves the decision making of financial statement users. It would be more difficult for the business to manipulate its financial statements because once we consistently use a certain accounting policy or method without good reason, you cannot change it. So the manager or the financial manager, accountant of the business cannot change the method in order to show a better result to get more reward by the senior managers. So the users would not be easily misled. Next one, accrual concept. Okay, the definition of accrual concept is that transactions should be recorded in an accounting period in which the events occur. regardless of whether or not cash has been received or paid. The important word is regardless of whether or not cash has been received or paid. Look at the timeline below. You see, from the beginning of the year, to a certain point of time, you have paid rent for $1,000, but you still owe $200, which has not been paid to the tenant. So in order to calculate the total rent for a year, we should calculate from the day one to the end of the year. That means the total rent should be 1,200. Though we have only paid $1,000 cash to the tenant for rent. It does not mean that the rent for the year is $1,000 because we still owed $200. So actually, accrual concept means whether or not you have paid cash or received cash, we should not only record the cash transactions as a rental expense. Remember, even though some rent has not been paid, but it has incurred during the accounting period, accounting year, this $200 should be added to the amount paid, $1,000. That means the total is $1,200 instead of $1,000. The implication is about revenues are recognized and recorded when they are earned. We stress on these words, recognized and earned, not when cash is received. Just like your mom has paid cash for you monthly, okay, $1,000, but ma'am has only paid you 11 months. That means 11 months. That means $11,000. But in December, your mom has left you for a holiday, so you will still recognize the December petty cash, okay, petty cash, pocket money, as your income, right? So actually, you have earned this amount December pocket money, okay? So Q is not when cash is received. Just like expenses, okay? Expenses are recognized and recorded when they are incurred and not when cash is paid. QS is incur. Incur does not mean that cash has been paid, but once you have received the services from somebody, say for example from the worker or employees, you have to pay salaries and wages. Salaries and wages belong to expenses. So remember, even though you have not paid the salaries and wages yet, such expenses has been incurred during this accounting period. So we make use of the word incur instead of the cash paid. Question: Andy runs a motor services center. On the 28th July 2016, a customer leaves his vehicle for repair. Andy repairs the car on the 31st of July 2016. The customer picks a vehicle on the 1st of August 2016 and mails a check payment to Andy on the 5th of August 2016. There are many days. You should know when the income or the revenue should be recognized by Andy as Motor Services Center. Question: Andy receives the check and deposits it in a bank on the 6th of August 2016. According to the case, when should the service revenue be recorded by Andy and explain? Many days. But according to the definition of accrual concept, Andy should record the service revenue on the 31st of July 2016 because the repair services have provided on that day. Remember, services have been provided. That means the income has been earned on that day. It does not matter the check was received on the 6th of August 2016. That means check payment or check received from the customers is not a matter. This will not affect the recognition date of the revenue. That means once the services have been provided or rendered to the customer, the day is important day to Andy because the revenue should be recorded on that day. Okay, next question. Explain the meaning of the accrual concept. Give one example of an accounting treatment which applies the accrual concept. Again, remember the definition of accounting concept, which means transactions should be recorded in the accounting period from in which the events occur, regardless of whether or not cash has been received or paid. Example is a credit sales transaction applies the accrual concept. Again, credit sales transaction is one of the accrual concept example. Once the business sells the goods to the customer on credit, that means the customer must not pay for the goods received. The customers can settle their amount later, right? Later, sales revenue can also be recognized when the goods are delivered. That means when the goods have been delivered to the customers, even though the customers have not paid yet or agree to pay later. Once the goods have been delivered, the day is an important day to the business because the sales revenue are recognized on that day. Making use of the accrual concept on cake coupon, just like this picture, okay? What is a cake coupon? It is a common marketing tool of cake shops. Customers purchase and pay for the cake coupons and give them to people for later use. People can exchange the coupons for cakes when presenting the cake coupons. Very simple. Okay, an example of Dong Hai Tong, okay? Aromi cash coupon. The important thing is this transaction creates an accounting question. When should the revenue be recorded? Should the revenue be recorded case one, when the cake coupons are sold? Number two, when they are exchanged for products. Which one should be correct? According to the accrual concept, revenues are recorded when they are earned. Keyword is earned. Okay, that is when the products are sold and delivered. That means you present the coupon for the cake. At that time, the revenue has been earned. Go on. Therefore, the revenue on the cake coupons should be recorded when they are exchanged for products. Correspondingly, the cake coupons are not redeemed by customers, are treated as liabilities. That means you have received cash from the customer, but you have not provided cakes to the customer. That means it is a kind of liabilities because you have gained some benefit from the customers. That means receiving cash from the customer without doing something or providing service or giving goods to the customers. So it is a kind of liabilities. When prepare the journal entries, when the cake shop has sold the coupons to the customers, the shop will debit cash. Just look at it, plus minus. That means we debit cash. That means to increase the amount of cash in business. But such a sale of a cake coupon has not provided services or goods to the customers. So it is a kind of unearned revenues. It is a kind of liabilities. So we use minus to represent our liabilities. So we credit liabilities. We credit unearned revenues to show that the cash has received without providing services to the customers. And after the cake coupons has been presented for cakes and taken away by the customers, the unearned revenue will decrease. So we debit unearned revenues. That means we reduce the amount of unearned revenues, or we reduce the amount of liabilities. Well, it is a kind of sales, so we credit sales. To means that the sales has been increasing. I hope you understand the CC back concepts, and this is the end of chapter 6.